I think, shall we start?
Yes, please.
Yes, good afternoon, good evening, everyone, and welcome to our webinar on AI-powered credit scoring and lending, revolutionizing access to finance. My name is Yari Dendale. I'm the General Manager for Eastern Africa and the Country Manager for Ethiopia at Visa, based out of Ethiopia, and I'm very thrilled to be your moderator for this session today. I'll start from my experience because this topic is a bit closer to heart as well. I've had a couple of experiences on this in my previous role. So I'll start giving a background on what we have done in Ethiopia. Ethiopia has witnessed an extraordinary surge in AI-powered digital lending, growing by an impressive 350% in 2025. The growth in is not just for me. It's not just a statistics. It's signals a fundamental shift in how individuals and businesses access credit. Traditionally, access to finance has been one of the biggest barriers to economic participation, especially for underserved communities and small enterprises. Until recently, there are less than 400,000 borrowers in Ethiopia. And today, we have millions because of the fact that we have started digital lending very recently. So digital lending, leveraging AI-powered technologies to break down these barriers, offering faster, more transparent, and more inclusive credit solutions. It enables people without traditional collateral or banking history to access funds through mobile platforms and alternative data. This is particularly relevant in Ethiopia, where mobile penetration and fintech innovation are creating new opportunities for millions of Ethiopians who were previously excluded from the formal financial systems. So this webinar is the second session of the series, Unlocking Africa's FinTech Potential through Digital Leadership, jointly presented by the United Nations Economic Commission for Africa, UNECA, and the 10 times 1000 Tech for Inclusive Initiative, a global program empowering digital lenders to drive inclusive growth, organizing for Africa FinTech Network. So this session is being recorded for our global case study library. Please note that you are welcome to use the chat or Q&A function to ask questions or share comments. So without further ado, let's welcome our first speaker. It's my pleasure to introduce Mr. Sanjay G. Munger, founder and CEO of FinClub, CEO of Impertech Mauritius, and GMI Capital Partners Limited. Sanjay is a strategist with 30 plus years of leadership in SME development, digital finance, and inclusive innovation. He has pioneered AI-powered P2P lending and risk assessment across global markets. His talk today is on how AI is transforming credit scoring globally and in Eurasian markets, fintech's role in expanding financial inclusion, and lessons from FinClub's success stories. Sanjay, welcome, and the floor is yours.
Thank you, Yared. Good afternoon, everyone. Thank you again for giving us the opportunity to be present to showcase a little bit about what FinClub is doing. I trust everyone can see my slides. Is that correct?
Yes, we can see your slides. Please do the full screen mode.
Excellent. So I'm going to talk about a little bit FinClub. You know, we are based in Mauritius. We are based in Mauritius, and we are serving the Mauritian market. As Yared mentioned, one of the other hat I also wear is that of CEO of Impertech Mauritius, which is a regional advisory, capacity building, and business facilitation organization. And basically, wherever we are working, whether it's in Africa or in Mauritius. In Africa, we have handled more than 300 projects for local and international agents or institutions like the European Commission, the African Development Bank, COMESA, SADC, Indian Ocean Commission. But wherever we are actually operating, including Mauritius, the access to finance has always remain a major issue, a major point, which is something very often is decisive difference between the dream realized and the dream abandoned. We've seen entrepreneurs with brilliant ideas but no collaterals, SMEs with strong cash flow but no formal credit history, business considered too small to be bankable, yet too promising to be ignored, and so on and so forth. Actually, if we take even Mauritius, is no different because in 2017, Empretec Mauritius was called upon to make a study and come up with a strategy paper, which is called the 10-year master plan for the SME sector for Mauritius, which is actually being implemented by the government. We are not different. Despite all the strength that we have, we are no different, and we have more or less the same thing. So we thought, what shall we do about it? And back in 2018, we set up FinClub, which is a peer-to-peer lending platform, the first one actually to obtain a license from the Financial Services Commission, the non-banking financial sector regulator in Mauritius. Right from the outset, we starting the development, the idea was to initiate, to develop, to code, to make sure that we can cater for the Mauritian market, but also cater for other markets and eventually scale out to other countries. And for some of you who might not know, basically, peer-to-peer lending is putting people who needs money, that is to say borrowers, directly in contact with people who have money to lend to, that is to say lenders, that basically bypassing the financial institutions altogether. Our lenders are individual institutions, and today our loan size varies between 10,000 rupees to 5 million rupees. 10,000 Mauritian rupees, about 45 Mauritian rupee to the dollar, so ranging from $225 to $110,000, which is in some way quite consequential. We are 100% online, so application is done online. All documents are uploaded online. We have a different series of 4 or 5 different types of loan, whether it's for consumer loan, ranging starting from 10,000 rupees, so that's already quite a small, quite an inclusive amount, and somebody can borrow that for only 1 month, and eventually on the other side of the spectrum, we are talking about SME loan that can go up to 5 million rupees over a tenure of 5 years. By the way, we also have initiated a few months back, green loan, adapting to the climate change, etc., and financing green loan both for individual and SMEs. As I mentioned, the lenders can be individual, but very recently, about a year ago, we have also now started onboarding institutions. So our lenders can be both institutional and individual. And today, after almost 4 years of operation, you can see on the board, on the PowerPoint here, we received something like 13,523 applications for a total amount of more than 2.3 billion Mauritian rupees, which is about $51.5 million US dollars. The number of loan approved is about 1/8, so about 12-13%. 1,625 loan approved for a total amount of 270 million rupees, which is more or less about 6 million USD, with a success rate of 97.53%. That is to say, the default is as low as 2.47. And actually, even our default is not typically the nomenclature of a banking default. For us, we classify default as being 91 or more days late. So maybe on 92 days, the person will pay. So it's not really non-performing as such, but in the context of the regulatory needs, this is what we are reporting. Our average time to fund a loan today is about 3.6 days, which is quite interesting and reasonable. So this is the figure that we are almost, this is the figures of yesterday. So how did we arrive there? So again, we can show a little bit about the performance of our platform. You can see on the left-hand side, the loan application received. On the right-hand side, the amount, the average loan amount, and as we went through the time it takes us to fund a loan. You would see, for example, the first loan took us about 33 days to be fully funded, which is quite some time, and not many people were able to wait for that. But that was, among our first loan. Since then, our system has improved. We are using a lot of AI capabilities. Our data performance and the ability to ingest and analyze data has improved. And as we progress, during, you can see for example, first year, 17 days to approve a loan, to fund a loan, then 11, then eventually it went down to 1.3 days to actually fund one loan. And given that also our average loan for example, September 24 is 174,900. That has changed a little bit. So now it's 3.6 days. Why? For two basically reasons. One is our maximum loan size last year was 1 million rupees. Now it has gone to 5 million rupees, and obviously it's taking more time to have it approved. And also in terms of the processes we have on board now, since February of last year, February 2024, we are also giving SME loans. So the analysis, the process, and so on, obviously had to be adapted. So the two reasons why loan funding went up from 1.3 days to 3.6 is loan amount raised from 1 million to 5 million, and the SME loans that we are actually giving. Obviously, to arrive at that, and despite the quite important, quite impressive number of loans that we are actually giving, you would see that. I mean, I should perhaps highlight that our credit team, we have only 7 people in the credit team. So it's quite impressive and important for the number of loans being. How we are able to do that is precisely, and that's the topic today, having developed and using AI and machine learning to kind of to ensure that a lot of work is already being done through our various analytics, but it's basically simple. If someone comes to you and say, okay, I need a loan, I would like the loan, the first question you'll ask, but how much do you earn? What is your salary? Simple question. That's basically you would not want to check whether the person has the capability to repay back the loan. If the amount requested, let's say 10,000 is too much, you would say no, either I reject that, or you can say no, but I won't give you 10,000, I'll give you 3,000, for example. The second question basically is to say, okay, good, you have the repayment capacity, but I would like to know over the tenor of the loan whether you have financial stability to be able to pay back. Okay, that is to say, we started looking at the sector, we started looking at the personal status of the person. And finally, you would also like to know, the behavioral aspect, the capability of the person, sneak peek, check with the neighbors, check on social media platform. Well, we are not doing that, but that's probably the digital version of doing that, is to look at that. So as you can see, we have got here three in the parameters that we are using to analyze credit worthiness. We have got three family. One is looking at the financial data, and that we are very much basing ourselves on the MCIB, Mauritius Credit Information Bureau of the Bank of Mauritius. The socio-demographic factors, that's the second part, to check on the stability of the person. Example, as I mentioned, for example, farmers, their income is seasonal, so you would like to check, verify, etc., how consistent their incomes are. And finally, looking at the willingness of the person. You may be able to pay a loan, you may be stable in terms of income, but you might not be willing to pay the money back. So checking the willingness, and that's looking very much at behavioral aspect. And as you can see, we are actually analyzing 48 sub-parameters with more than 287 data points, 85 actually data points, that we are kind of analyzing, verifying to be able to arrive at a credit score, which basically is risk-based, okay? Our loans are classified. If you go on our website, finclub.mu, you would see our loans are classified A+, A, B, C, D, etc. D. Basically, that's based on the data that we are analyzing, on the family of data that I did mention. So we are relying on many, as I mentioned, the MCIB, Mauritius Credit Information Bureau, analysis on bank statement, income, liability, and also all that's being ingested on the AI credit scoring engine, which is in itself very modular and configurable to ensure that we are analyzing various data, various information to ensure that the risk, one, is consistent. Second, it's consistent, and loan approval is very quick. Voilà. Very briefly, a little bit about FinClub. Obviously, later on, I will remain available to answer any specific questions that the audience may have. Thank you, Gareth. Back to you.
Thank you, Sanjay. I think so. Let's go to the next session. In the interest of time, third segment. I think we are gonna speak about advanced risk assessment and lending in Africa. Thank you, Sanjay, for the global perspective. Now, it's my honor also to introduce Mr. Shailesh Malay, Senior Vertical Solutions Consultant at Lenses Nexus Risk Solutions. He's a seasoned technical delivery manager who excels at lending complex initiatives from ideation to completion. His expertise spans digital transformation, risk management, and regulatory compliance. Tonight, Shailesh will discuss the practical applications of AI in risk management and lending within East and Southern Africa, and how alternative data can help expand access to credit. Shailesh, please take it away.
Thanks a lot, Jared, for nice introduction. Hi, hello everyone. Good afternoon. Good morning. I'm Shailesh. I'm from LexisNexis Risk Solutions. I'm based in Singapore. And a little bit about LexisNexis Risk Solutions. We are global leader in providing credit risk, fraud protection, financial crime, and compliance solutions globally. And in next 15 minutes, I will walk you through some of the challenges, opportunities, and innovations what we see in the market. Okay. Can someone confirm you can see my screen?
Yes, we can see your screen.
Okay, perfect. Okay, so when we think about Mauritius, the iconic lighthouses immediately comes to mind. They are steady, bright, and unwavering. The role of AI in modern credit risk management is somewhat similar, uncovering hidden insights, providing reliable guidance at speed, and ensuring every decision is reliable and also explainable. Today's agenda, we will go through some of the challenges and opportunities lenders face around modern credit risk management. We will also share some of the insights we see some of the leading lenders are using and their outcomes. And if time permits, I'll quickly walk you through a case study as well. So let's start with key challenges first. And these are based on the global study we have performed that covers entire globe. And the key challenges which are coming up is starting with first the credit bureaus. Hope this collage brings the vibe of Africa from 1990s, right? But it's also the era when credit bureaus rose to prominence, perfectly suited for the world of limited data, slower processes, and simpler risk. The digital services in 90s, uh, which were offered in Africa, also there is no way to track or collect user data. User left almost no digital footprint, but that is changing now. Also, when we compare the browser borrower's profile from 90s to 2025, we see huge differences, right? Back then, it was more formal jobs, formal credit products, and a very asset-focused, cautious spending. But if you see now the Gen Zs and the generations, they're many of them aren't even in 9 to 5 jobs. They prefer leasing, renting rather than buying asset. They use innovative products like embedded credit, BNPL, and subscription. Uh, Many of these are not even get reported to bureaus. And they live in a mobile first world powered by super apps and social commerce. So the question here is, can credit bureau alone truly capture the risk profile of these two personas? Also, another challenge lenders are facing is the unique characteristics of fraud in credit applications. Fraud in credit isn't all the same, right? It starts from a very basic first party fraud where someone is using their own identity, own credit data, but have no intention to pay. From there to identity theft to manufacture synthetic identities and then manipulated synthetic identities. The description and indicator shows each of them are very unique. So when lenders are onboarding new borrowers, it takes multiple strategy covering fraud and credit risk management. And this is where we see a lot of opportunities. These challenges are also pushing financial services to modernize their risk management system. The ask from the lenders is very simple: stitch data, analytics, and workflows into low friction onboarding, intelligent decisions, and proactive risk monitoring end to end. Which brings us to the next session where we'll go through some of the innovations we see in the market. So the first innovation we are seeing is cross-industry digital identity intelligence network, right? Now think about contributory intelligence as a bureau model for digital identity, digital footprint, which showcase the mirror for your digital activities. As bureaus pull trade lines to predict ability to repay, these networks pull event data across number of platforms, to predict fraud and credit risk, and effectively reducing defaults and approving more customers. If you remember the slide from Sanjay's presentation, the number of applications and received and number of approvals, we call it as open jobs. Now, our attempt is to close those jobs as soon as possible so that the lenders like FinClub can access a quality borrowers, but also they are uncovering new segment. So this is a quick example how the digital identity cross-industry network work. So the first event shows us that there is a maybe event coming from mid of Africa. Okay, based on the data what we see, it looks a clean event, and the risk uh, indicator for this event is looking very low risk. Then we see certain other events linked to this particular identity. Now, based on the risk profiling, it looks a medium risk event, right? The next step is where the lenders, the financial services provider, probably giving a feedback back to this network that there are some of the frauds and some of the credit defaults linked to this particular digital identity. Now, when I combine all these signals, the risk profiling is now going into high risk segment. So this is how the digital identity network work. We, as a LexisNexis, we have one of the biggest digital identity data network in the world. If you think about world population as 8 billion, around 60% of that adult between 15 to 64 age, so that's around 4.5, 4.8 billion. So we are having a very good coverage to represent the activities coming from this online population. The next challenge or next innovation, what we are seeing is in the field of alternate data. Now, credit bureau data often provide you insights based on the events which has happened in past, maybe 6 months, maybe a year ago. Great for history, but not what is happening right now. This is where the alternate data comes in, right? The alternate data gathers events from variety of these channels, and then it provides us uh, behavioral changes, mismatch between digital and real innovation. All these signals are very useful when you're onboarding a new customer for that particular loan. The next innovation, what we are seeing is the need for orchestration. Even in 2025, we see that most of the risk tags are still a set of islands, right? ID verification, KYC, KYB, fraud checks. Each has a specialized rule, specialized case management. But this also means there are blind spots and inconsistent decisions, which are adding and making these checks costly. So where some of the leading strategy or lending companies are moving is orchestrating their credit risk system. And now this is stitching all the signals across all the channels, applying share rules, applying machine learning and AI, and creating a unified score. The payoff is faster onboarding, lower cost, and full auditability of the policy. After this, we will look into one case study which is catching lenders off guard worldwide. These are defaults tied to synthetic identity. Now you may think, how can something which is even not even a real person slipping through the robust KYC and credit checks? So let's find out. The key to spot synthetic applications is to look into the DNA of identity. Do they have real-time connections, or do they exist only in the financial lines like credit bureaus? Do you see near duplicates tied to one location? Do you see the details look tweaked? Do you see the same phone number is tied to multiple emails? All these signals are telling you that there is something which is not in line or not normal for this particular identity, and that uncovers the synthetic nature of this. So when you look into the digital, or when you look into the identity, we see this as a jigsaw puzzle. Each piece, whether it's a digital footprint like IP address, or a physical detail like name or address, or a behavioral cues, they represent a proof point. Alone, each piece can tell you a story, but only when you fit in all together, you see a full picture, a 360-degree view. And AI and machine learning play a very, very important role in building this picture, because we are talking about processing billions of events, finding out the commonalities, and stitching together a consistent picture which our lenders can use to onboard that particular customer. Now, there are some real life example what I'm going to show you. So this particular case, and these are all live examples from our clients who are using our products. So this particular example is showing one digital identity accessing multiple accounts. So they might have created a number of accounts on a BNPL provider, or they might have opened number of loan account, or they might have taken number of credit cards, right? In these 30 events, we are able to uncover that there are 10 account names used in these events, and there are also 14 devices linked to it. The mesh or mesh on the right hand side, that shows how complex these identities and event can be. So here you need a good data analytics. Here you need a good AI and ML to drive the insights. And the insight is telling us this could be a high risk transaction, because the past shows that this is linked to multiple names. The next example becomes furthermore interesting, right? Here we are looking into example coming from South Africa, and what we are looking into a device ID. Now, device ID could be linked to my phone, could be linked to a laptop, or could be linked to a tab, right? For this particular device, we see that there were total around 250 events we saw on this BNPL client's transactions. Out of that, 156 went through, and they were linked to 30 IPs. If you see the geographical footprint, it's almost covering entire South Africa. So this is definitely a synthetic ID network, which is creating multiple synthetic account and applying and getting these credit product. The last example is showing a much more complex view, right? In this example, this particular network has raised around or shown around 180 events. Out of that, 113 went through. Those 113 events were linked to 45 names, 45 email IDs, 3 devices, but all linked to one shipping address, which is based in South Africa. If you see the originating events coming from either Joburg or Cape Town, but the delivery address is not that. So when you stitch all these events together, you see this picture that, okay, this digital identity, which we call it in a very, very encrypted format, is linked to a one shipping address, but linked to all these accounts. So this is how fraudsters and scamsters are using latest technologies, because they don't need to align to any regulation, right? And they're manipulating these products. And when we actually stop them, we are actually helping lenders to drive the financial inclusion, ensuring that their loans, their credit products go to the needy person. So with that, I will stop here. We'll open again for question at the end of the session.
Thank you, Shailesh. Thank you for your contribution on Africa FinTech innovation. We'll have a couple of questions that will directed to you, and they will come back later on. So next, I'm excited to introduce Mr. Ivan Bo Jen, General Manager of AI Department, My Bank and Group. Ivan leads innovation in financial services through AI, developing technologies that empower SMEs and consumers alike. Ivan will share the latest breakthroughs in AI-powered lending at my bank, impactful case studies, and China's unique digital financial infrastructure. Over to you, Ivan.
Okay, thanks for your nice introduction. Good afternoon, everyone. It's a great honor to be here. I'm Bobo Chen from my bank in China, a digital bank that uses technology to empower small and micro enterprises. I will call them SMEs for our discussion here. Today, I'd like to share how we are using AI to make financial service more inclusive and accessible for millions of SMEs. My bank was founded on June 25th, 2015 by Ant Group. We were among the first batch of privately owned banks approved by China Banking and Insurance Regulatory Commission, and also the first cloud-native bank in China. As of the end of 2024, we have served more than 68 million customers. 72% of them had never borrowed from a traditional bank before. On average, they use our service 8 times a year, with a loan balance about 72,000 Chinese yuan and a loan cycle about 150 days. During this time, we have developed 4 AI systems, each named after a bird. Tomtit use images from satellites to check farmland and give farmers instant loans. That's one photo from space and credit. The second bird named Nak, an intelligent interactive risk system to help SME get higher loan credit limits based on self-certification. Goose use AI to map SMEs in supply chains, identify underserved businesses, and extend credit access. Cuckoo help SMEs earn returns on idle cash. We know now AI is reaching a turning point, powered by large language models, deep understanding and content generation, complex reasoning and planning, multimodal integration and action. These capabilities are driving real change. Let me share a real-world practice from my bank. Over the past decade, SME lending has moved through 3 key stages in China. Stage 1, can SMEs access credit at all? Thanks to the rise of internet platforms, this question has largely been answered. Today, many banks offer full digital unsecured loans about tens of thousands of Chinese yuan, available with just a few taps on a smartphone. Stage 2, is it enough? As business grow, SMEs need high credit limits, up to hundreds or thousands of, or even millions, and still expecting the same instant experience. To meet this need, my bank introduced Luck 3 years ago. One of our tech birds is an intelligent interactive risk system to let customers upload their contracts, invoice, and other data to prove their financial strengths and request higher limits. Stage 3, it's good. That's where we are today. Many customers now have limits between 500,000 and 2 million Chinese yuan. But a new challenge has come up. Service stability is insufficient. Why is providing stable credit to SMEs so challenging? Because they are deeply affected by market changes, supply chain shocks, and even weather. Their industry are highly diverse, each with its unique risk and patterns. Especially with a low digitalization, critical data still live on papers in factory, and the risk is difficult to quantify. To bridge this gap, traditional banks have long depended on manual reviews, on-site visits, and human judgments, but these are slow, costly, and hard to scale. So, we face a tough choice. Online service is convenient but unstable. Offline service is stable but inefficient and limited in reach. Can we have both convenience and stability? In the age of AI, we believe the answer is yes. What if AI could be a real credit expert, one that truly understands every business? That's what we are building at my bank. It has two intelligent assistants. One is an intelligent industry research assistant, and the other one is due diligence assistant. Now, let me show you how AI credit expert works with a real example from a small company in Yueqing City, Zhejiang Province, China. Based on public data, we can see this company is a high-tech enterprise with 27 patents, 8 years in operation, and makes electronic equipment. With this limited information, traditional banks can't offer unsecured loans. But what's under the surface? Our intelligent industry research assistant analyzed industry reports and mapped the full supply chain and discovered something important. This company specializes in socket collectors, and its products are used by global brands like Xiaomi, BYD, and Unitary Robot. That's not just a customer list, it's proof of quality and reliability. To understand their current performance, intelligent due diligence assistants step in, not with forms, but with conversation. It asks smart questions, reviewed documents, and gathered real-time data. We can see that the company's revenue grew by 35% over the past year. All sign of a healthy, growing business. Based on all of this, the AI credit experts recommended a credit limit about 1.5 million Chinese yuan. How is it possible? It's made possible by breaking throughs in AI. Let me show how intelligent industry research assistant works in detail. Instead of one single AI model, it uses a team of 5 specialized AI agents working together like a research team, analyze industry reports, extras key frameworks, generates credit risk features, validate the accuracy of these features, and lastly, fuse all of these validated features. Together, they have built deep industry knowledge, covering thousands of sectors, from healthcare to food and beyond. What about intelligent due diligence assistants? Just like this short video, the customer can simply walk through their factory with a smartphone, filming key areas. In minutes, the AI assistant captures critical details, advanced equipment, clear product lines, standardized operations, all analyzed in real time. All this data, text, voice, video, flows into a unified large language model we train specifically for credit understanding. It automatically generates structured due diligence reports and a 360 degrees view of the business. So where traditional banks send people to on-site checks, our AI assistant brings the site visit to us. How does the AI credit expert make the final decision? First, we translate expert knowledge into decision rules. Then we create high-quality code-start COT datasets by combining expert experience with large language models. Next, we train the model using curriculum learning, starting from simple cases and scaling to the complex cases. Finally, we improve decisions with reinforcement learning and strictly hallucination control. Through cross-validation, fact-checking, and monitoring to ensure the model decision is reliable and trustworthy. Over time, the AI credit expert has achieved some transformative, intelligent, and automated credit approval. So, what's the results? In just 5 months, our progress has been remarkable. Deep understanding of 100 industries, due diligence efficiency up by 3x, AI to human approval result consistency ratio surged from 39% to 90%, which is a strong validation of the model's accuracy, consistency, and reliability. With the AI credit experts, we are delivering more stable and high-quality credit service to SMEs. So it is time to build the new 3.1 model for the AI era. The original 3.10 defined digital finance, 3 minutes to apply, as fast as 1 minute to disperse, zero human intervention. Now, in the age of AI, the new 3.10 means 360-degree understanding of every business. One-to-one expert service. More and more experts become agents. Zero latency interaction, instant and always on. Thank you for believing in the power of AI to build a more inclusive, intelligent future of finance. Thank you all.
Thank you, Bo. I really appreciate that. I think we have reached to a point where now we will gonna make the panel more interactive. There will be a couple of questions that will come from the audience. Until then, let me ask one of my questions. While the team puts together the questions. So the first question that I want to ask is, how can AI-driven credit scoring models enhance operational efficiency and reduce default rates for lenders in Africa? Sanjay, do you want to take this one?
Okay, thank you, Yared. I mean, basically, as I gave from the figures, we are talking about huge volumes. And generally, fintechs are very small companies, startups, small teams. So already first benefit is to kind of, it's fast decision making. with the use of a lot of automation. For example, all our email triggers are automated, documentation and so on are automated, so you do not really do any of that manual. Secondly, time to process an application, time for credit score, and eventually having the right information presented to the lenders so that they can make informed decision. That used to say the time for funding basically become shortened, and that's, as you have seen, last year we were approving a loan in funding a loan in less than 1.3 days. The other point is basically also having consistent decisioning. That definitely AI and FinScore, our AI-driven tool, credit underwriting tool, is kind of helping us do that, having that consistency into that. Now, given that, for example, when we started, we had very limited data. Mauritius is a small population. We had very limited data. So what we did was to use various models. We obviously had the logic-based model that enabled us to start. But as we proceeded in the, getting more loans, getting more data, we transited more toward that. But having said that, we are kind of still keeping various models running in parallel to ensure that the consistency. And finally, using AI also allows us to flag and also analyze both lender behavior and borrower's capability, because then we, through our responsible lending policy, we do not want to overburden people. We do not want to over indebt people. Here you go.
Yeah. Thank you, Sanjay. I'll take one question from the Q&A, side. Dave Chow asked, how many transactions and data pointers are sufficient enough for your AI model? Maybe Shailesh, do you want to chip in on this one?
Yes, sure. Interesting question. For us to build stable models, we need minimum 500 default cases to just build. So if you look into maybe your last 3 months of data, maybe you have received 10,000 applications. Out of that 10,000 applications, 50% approved. And out of that 50% approved, 5,000 applications, maybe 10% default. So 500 loan borrowers defaulted. Once we hit that number, 500, we can build a model. Okay. Then we continuously monitor the model's performance, how it is performing on a live data. If we see model is deteriorating in terms of its metrics, then we can further add data and calibrate it. But to give you an answer, 500 EPD, 500 default cases is good enough to build a stable model.
Thank you. Thank you, Salih. Another question from Work Walamayo. How is AI helpful in mentorship and follow-up once a loan is offered to a loanee friendly? It is, I think, the support that we'll get on AI to educate, the individuals who are learning. Do you want to take that, Bo or Sanjay?
Okay, I mean, if I can go first. Basically, we have dashboards. Okay, we have dashboards that enable us to follow the payment trend of the borrower. Obviously, I think it is important even before giving the loan to analyze certain facts. Example, let's say somebody gets a salary on the 5th of a month. There's no point in putting a standing order, for example, on the 30th, because every time it will bounce. So, there are important decisions to be taken well before a loan does that. That, prevent, moving on the preventive side. Now, on the follow-up side, obviously, the tendency to repay, to check out the pattern. Mauritius is very well banked, we have to say. And therefore, a lot of our transaction is done bank to bank. And as such, we do not really have to go and fetch people out. But nonetheless, given that it's unsecured loan, given that it is dependent very much on the person to ensure that the loan payment is triggered on time, it so we have, for example, built in on our model 2 days before a loan due, EMI is due, you have either an SMS or an email that automatically is triggered. If the person has paid, you say like a little thank you note. If the person hasn't paid, 1 day later, you have another trigger. So basically, there are inbuilt triggers on the platform to follow up obviously, when it reaches like 30 days, then there are phone calls. If it reaches 60 days, then there are site visits and so on. So it's a very comprehensive approach.
Yeah. Thanks, Sanjay. I think, in the interest of time, I wanted to ask, one of the questions that are very relevant, I'm sure, who our, participants would agree, is uh, in regards to regulation. So the question that I have is, what are the regulatory considerations and compliance challenges with AI in Africa lending? Maybe Shalesh, you and Bo, if you wanna, contribute on this one.
Yes,
Uh,
sure. So maybe I'll start. So in terms of applying AI in the credit risk use case, the first is what data is being fed. Is the data collected using a proper consent from the borrower? Are we looking into some shady data set, like looking into someone's SMS, someone's call log, someone's photo, right? So there is a strict guidance and regulation in place what data can or cannot be used for the credit use case. So that is the first baseline. Second thing, in terms of being compliant to this regulation, you have to make the AI model explainable. Now, I could see one more question which says AI is black box, right? But right now, with the latest technologies and the various tools available, you can still put a very explainable outcome for your AI. What features this AI model is consuming, what are the weightage, how it is avoiding certain bias like maybe gender or maybe the location and other things. So all that thing can be considered while you're building the AI model, and then a thorough uh, model documentation or specifications are good enough to clear some of these regulations. So our solutions are being used by a number of banks and regulated entities, and we are able to get it through. So yes, it looks like a black box, but with the help of technology, now we are seeing a good adoption and good support from the regulator as well. Maybe I'll give it to go Abo to add a couple of things.
Yeah, Yared, if I may ask, for example, in Mauritius, what we did, before the actual license was issued to us, we had the regulatory sandbox license.
Mm-hmm.
That allowed us to start the process, get to understand the market, and also ensure that compliance is done, obviously. And I still have to say, compliance is remain a major challenge. It took us almost 2 years to get the license, but nonetheless, I think it is something which is important, which is critical, as Silas mentioned, ensuring, for example, compliance, having access to consented data, and so on.
Understood. I will ask one more questions for Bo, if you want to, contribute on this one. Haptamu Komelacho asked the question: how could AI lending achieve financial inclusion in Africa, or in related markets or similar markets, particularly those non-banking community using digital lending, considering limited ICT infrastructure and poor data quality management? In these kind of scenarios, how could we achieve what we would like to achieve from your experience?
Okay. First, I will give thanks to the Chinese government for building public data platforms in areas such as credit reporting, tax invoice over the past 10 years. This may be our advantage in China. Just like just like the slides, maybe we use a smartphone to filming factory key areas to get more data. This may be an effective way to gather data to build a credit model.
Understood. No, see, I'll also contribute on this one from my experience. I think the question comes from one of an individual from Ethiopia. So in our case, yes, the infrastructure, data accessibility is very limited. But where we started, I remember a couple of years ago, is start with a little data that we have. For example, the KYC information the customer has, the business license, etc. And then also probably a little transaction that they have in any platform that we are giving this lending to, and then build from there. Start from a very less risky amount of loan, and then build the data from there. See how the customer performs, and then from there, the data will start to build up. I think one of the way to build this for the community is to starting from small and then growing it. And when the lenders, actually the customers usually continue working with you, and then more data will be collected through time, and that is also something that can get us to that point. I think with this, we also are run out of time. I would like to thank you all for really contributing, especially our panelists to contributing to this conversation, and it is very relevant to our context. I really appreciate everybody who has joined us today for this session, and have a great day. Thank you. Have a great day.
Thank you very much. Thank you.
Thank you, Paul. And it's the webinar is officially over. Thank you so much for the very insightful and resourceful webinar. And we will share the recordings and all the notes and share. Oh, if you don't mind, we will share your contacts to the participants as well.
Yeah, sure. Do you have what you're going to share? Is it the LinkedIn information or our official mail if you have that?
It's the linking information.
LinkedIn.
So they can search. Yes.
Okay, perfect.
So
yeah.
I think we will officially end the session, and please enjoy the rest of the day and hope to work with you again. It's such a
Thank you.
pleasure.
Thank you.
You. Bye.
Bye.